The price of necessities are going up. The price of luxury items are going down. Banks are tightening. You see the restaurants are packed. You read on the news that everything's good. We're going to soft land. You see everything going up. Housing prices are going up. Stocks still continue to go up. Everything looks like we could do no wrong, and everything's going to keep going up. What did it look like before the Great Depression hit? Exactly like this. What's about to happen now, folks? Can you not just see it? This would be a period where you'd like to be in control, where you'd like to be out of debt, where you'd like to basically be able to call the shots instead of sit there and ride the roller coaster down. If you don't learn from the past mistakes that people have made, you will continue to make those mistakes over and over and over until you learn. Welcome, everybody. It's the first wealth webinar of 2024. So glad you're all here. It's awesome to see 110 people and climbing this early on for the first of many more videos and many more trainings we're going to do this year. Joined by, none other than Mr. Snaggy coming in from Florida. What's happening down there?
Hey, Happy New Year. Beautiful weather, beautiful new year, and ready to rock and roll, man. So glad to be here.
Awesome. So I had Stephen pull up a bunch of charts and a bunch of relevant factual data because, we often get the haters, more so on WTF. We get the haters going, we don't know what we're talking about. So I always just say, all right, well, let's pull up some actual data. And we pull a lot of data from the government because, hey, if you're going to believe data, you should probably believe that data. Or some of you are probably to the point now where you believe nothing that the government puts out. And I totally understand. But what I want to do today is I want to ask all of you a question to start this off. And this is going to kind of tell me what direction we're going to go. How many of you know what the economy and what things look like right before a recession? Put in the chat, put on if you know what it looks like right before a recession happens. I'll probably get a couple of people that do put an eye in there because they've probably been through a recession and maybe they remember what it looked like before. But I just want you to go way back in time. I want you to imagine 1926 through 1929. I just want you to envision that. All of you have seen the movies, right? You've seen The Great Gatsby. You've seen lots of movies about the Roaring 20s. What an awesome time in this country. It was such a time of economic prosperity. It was a time when it just seemed like everybody was doing well. There was so much work. There was so much prosperity. And then I want you to kind of fast forward through that economic prosperity. And I want you to think of 1929. Okay. And I want you to just envision that time frame for a second. Now, I know, or at least I think I know, none of you lived through that time. But all I want you to know is it was just booming. But what was it like right before the Great Depression hit? That's what we're going to start with. I mean, right before the Great Depression, things were so good. They were, it was just people were borrowing money. Everybody was making money in the stock market. Assets were appreciating. Real estate was going up. Seemed like everything you touched just turned to gold. Research that era, research that period of time, and you'll see that's exactly what happened. That's why they call it the Roaring 20s. But we all know what happened. The Depression kicked in. But it didn't just happen slowly. It hit swiftly. It hit fast, so fast. And it was so bad that you often have to really think about what happened. And that's really where I kind of want to start today. I want you to really look around. I just want you to look around today. Okay, I want you to look around every place you go, the malls. I want you to, next time you go to a restaurant, I want you to look around at the restaurant. I want you to look at some of the parking lots. And what you're going to see is you're going to see what I like to call the big lie. You're going to see the fake riches. Okay, you're going to see a lot of people with fancy handbags, fancy clothes. I live in Buffalo, New York. It's not exactly a wealthy area. I mean, there's pockets of wealth, but it's just not a wealthy area. And when I go out, rare, but I often do go out, I see a lot of this. And I know a lot of these people, and you can't be fooled by this because back in 1929, You know, there's many stories, but back in 1929, there is one particular story that I want you to really hone in on. And it was a story about Mr. Kennedy. We all know the Kennedy family. Well, let's take it back to Mr. Kennedy back then. You see, Mr. Kennedy was a savvy investor, a wildly successful businessman. And he was getting his shoe shine one day. And the shoe shine boy did not know it was Mr. Kennedy, the famous, business owner and trader and a really wealthy man. And the shoe shine boy was giving Mr. Kennedy stock advice, telling him that this stock and that stock and how he's going to, he should get into it because he's going to take off. It's going to go to the moon. And Mr. Kennedy, who, like I said, was a wise old investor, was sitting there listening to the shoe shine boy give him stock advice. And he thought to himself, he said, you know what? If the shoe shine boy is giving me stock advice, maybe it's time for me to get out of the market. Now, the story goes on to say that Mr. Kennedy went on and sold all of his money and he made a killing. He got out at one of the highest points right before the Great Depression kicked in and took everything down. Now, how many of you would love to have been in Mr. Kennedy's position at any other period of time in your life right before the entire market tanked? You got all your money out. You sold all your stocks. You got out at all your gains. How many of you would love that, right? Tess said, absolutely. Anna said, me. Terry, everybody saying, of course. In hindsight, it's 2020, right? It's so easy to see. Oh, well, yeah, I should have got out right there, right at the top. But then when you're right in the midst of it, now just imagine that you are somebody in 1929. You don't know what's coming. You look around, everything looks good. Everybody's got nice cars or newer cars. Everybody's dressed really nice, fancy clothes, the Gucci and the Armani and the Rolex is everywhere. The fake riches, that's what you see. You see the restaurants are packed. You read on the news that everything's good. We're going to soft land. You see everything going up. Housing prices are going up. Stocks still continue to go up. Everything looks like we could do no wrong and everything's going to keep going up. Do you realize that that's exactly what happened in 1929? Do you realize, although the clothing was different, the cars were different, but it was the exact same scenery. Nothing was different, folks. Credit was prevalent in 1929. It's even more prevalent today. So what I thought I would do is, because this is the first episode of 2024, and 2024, I assure you, is going to be a blockbuster of a year full of just the craziest things, from controversial elections to just the craziest things going on in business and the world and wars. And oh my gosh, you're already seeing it in the headlines. It hasn't even really kicked in yet. It still just looks, well, pretty good. Folks, this is called the boom cycle. So I'm just going to come over here and I got to kind of bring you through a little bit of just an education on an economy. And I'm going to I was trying to think about how to do this. I got lots of notes and I can talk, pretty fluently with you, but I figured a picture's worth 1,000 words. So let me just explain the boom and the bust cycle in the simplest way that I can. Now, when you think of a boom cycle, you have to understand what creates a boom and what creates a bust. Okay, they've been around since basically an economy was around, so forever. So what creates a boom? Well, let's create our own imaginary little isolated economy, right? We're just going to kind of create this tiny little isolated economy. That's all we're going to do right now. And an isolated economy, our little isolated economy, starts with a bank, a local bank. And it has some citizens in that area, some business owners in that area. One of them is a roofer, puts on cobble roofs. Another one is a shoe store. They sell running shoes and all the shoes that each of us wear day in and day out. Another one's just a retail store. And all of these businesses produce a product or resell a product or a service. And then they take their money, and what do they do with it? Well, the same thing we've been taught to do. They take their money and they put it into the bank, right? That's just what we're taught to do. They take the money they make from their business, from their paychecks, and they put that money in a traditional bank. Now, in this little isolated economy, there's only one bank. Now, how does the bank reward all these people for putting their money? Why would these business owners want to store their money in a bank versus putting it in a safe or a hole or under the mattress? Well, the bank offers to pay an interest rate on that money, right? So now, if you think of this tiny little economy and it has X amount of dollars in it, the money that's made here and the money that's put in the bank. Now, just imagine that to make money, let's just say the bank pays 3% and the bank loans the same money that's put into the bank, because typically these business owners, as they make money and they put it in the bank, they don't have a need for all of the money back. So it's not like they're putting money in the bank and immediately taking 100% of that money out and then putting a little bit in and taking 100% out. There's excess money. So what the bank does is the bank knows, based on the past, they know how much money at any given time is surplus. They know how much money is left over that isn't being used by its depositors. So what the bank says is they create a new service, a lending service. And they say, hey, what we're going to do, depositors, is we're going to take the unused surplus. What is the unused surplus, folks? Can anyone tell me? Isn't it just the money that all these citizens and these business owners put in the bank that they're not using based on some mathematics? That's it. But the bank doesn't say it's your unused deposits. The bank says it's their surplus. So the depositors don't really know that what the bank's actually doing is just lending their money back to them. And when they lend the money back in the form of a loan, they charge a higher interest rate. So if they're paying the depositors 3 and they're charging 5, what is the bank doing? They're making a spread of 2%. So this is essentially the simplest way to understand banking 101. But you see, the bank gets this crazy idea and says, you know what? We want to make more money. So the bank knows that every time it issues a loan, it gets a piece of paper called a note, okay, the loan agreement. So what it does is it then says, all right, we've got these loan agreements. What if we take these loan agreements and we use these as collateral, because they're as good as gold, right? These people are all going to pay these loans back. So we're just going to take this paper and we're going to go to a bigger institution, i.e. the government, and we're going to ask them to lend us money based on our assets. What are the assets of a bank? The loans, the loan documents are the assets. So effectively, what is the bank really doing? The bank is literally creating money out of thin air. These pieces of paper that the bank has, they're not real. They're literally, they're creating, they're lending money into existence. So now the government gives the bank more money. We call this fractional reserve banking. The government gives this bank more capital based on pieces of paper that the bank literally wrote into existence. And the government just says one thing, says, hey, to protect us, we want you to keep 10% of your money, your assets, in reserves. And those reserves have to be guaranteed. So the bank says, okay, Mr. Institution or Mr. Government, what would you consider good guaranteed places? And there's really 2 things. Number 1, treasury debt, okay? So government debt is guaranteed. So we'll call this bonds. Okay, so some of the 10% goes into government bonds, but the bank says, yeah, but if we ever need that money back, we don't really have liquidity. So what else can we do? And then they come up with, well, insurance companies have products that are guaranteed with contractual guarantees. We'll let you do those too, bully. So the 10% of all the money goes into those 2. So now I want you to just think about what happened here, okay? In the simplest form, people deposit money in the bank lends that money out at a higher interest rate, makes a profit doing that. But if we didn't create money out of thin air, there was only literally the growth in this economy is productivity growth, okay? Which is almost a straight line, because all productivity growth can grow by is if they produce more products, more services, that's productivity growth. So it's the only way the economy can grow until the banks found a way to literally create money into existence through fractional reserve banking. And that's what they do. So now they just start creating money and lending it out to more and more people at higher amounts. So now the roofer can buy more roofing materials, can buy more equipment, can hire more people and do more roofs, which means they make more money. And what do they do with the money? Put it back in the bank, which means the bank gets to make more fake money, lending it back out to the shoe store. What does the shoe store do? Well, they find out that they can sell shoes in other areas instead of their local market. They start selling them online. So then they start wholesaling shoes. They make their own brand of shoes called Nike. And they then wholesale those Nikes to this retail store. But in order to satisfy the retail store's needs, they need more money from the bank. So the bank just keeps lending it. And this goes on and on and on. And I know some of you were getting bored of that, but in this whole process, what you're doing is you're creating, instead of a straight productivity line, you're creating a line like this. Now, we didn't get into this yet, okay? This is the short-term debt cycle, and we'll cover this a little bit more in a moment, but I just want you to know it looks like this. What I just described is this cycle right here, the boom cycle. As the bank creates more money and lends more money, what happens? Each of these people make more money because they have more money to increase their businesses, so there's more income. As there's more income, what do people do? They spend more money. Once a luxury, now a necessity. We've all heard that, right? Before we had cars without air conditioning, now you wouldn't even think about it. Before we had cars with roll-up windows, now unless you're a race car driver, you wouldn't even think of that. Once a luxury, now a necessity. So this goes on and on, creating a period of time, usually about 5 to 7 years is how long this lasts in today's economy, where it just seems like nothing could go wrong. Now, notice how I said 5 to 7 years? How long's it been right now? 12 years, if any of you are keeping track. It's been 12 years that we've been going on with the cycle. But eventually, one or two of these people somehow borrowed too much money, and then all of a sudden they default on the loan. Stephen, real quick, can we just pull up a couple charts? If we can just show, do you have a chart of the current credit card debt, or could you pull one of those up in a second?
Yes.
So what I want you to know is what I just described is this is basically the first part of an economic cycle, okay, the boom cycle. We haven't yet covered the bust. We haven't covered what happened right after 1929. The summer of 1929 was the last of the boom cycle, because at that point, people started defaulting. Now, when someone defaults on debt, doesn't that create a chain reaction? One person defaults, that affects another person. So if this person defaults and the bank can no longer lend the roofer money, the roofer has to lay people off. So when the roofer lays people off, then there's people that don't have the income. So then what happens? They start to default on their debts, and then they can't afford more, and then more people get laid off, and then the bank eventually gets to a point where they're not going to lend to the roofer, so the roofer shuts his business down, defaults on all of his debts, files bankruptcy. Then all the people that work for the roofer no longer are buying shoes, so the shoe store slows down, the retail store slows down. It's a chain reaction. It happens faster and faster and faster. Folks, look at this chart real quick. This is Fred. We're going to look at a lot of these. I just want you to look at the periods of time. I want you to look at 2006, 2007, 2008. Okay, if you blow those areas up, these are credit cards and revolving debts. So you can see here, as we went into that, and then if I were to lay over interest rates, you would see that in 2008, they plummeted interest rates. But then look at that. What do you think happened in 2010? Does anyone know what happened in 2010? Wouldn't that have been when interest rates were pretty much pulled down to close to zero? And wouldn't that have been after $900 billion was printed and that money started really working in the system? Because actually, we're just the early part of 2010. 2009 was the whole bust. So there you go. Then it spikes up. Stephen, take us over to 2020. The world shut down. The pandemic hit. Credit cards and all that. What happened? For the first time in a long time, people were paying their debts down. It was a miraculous thing. It was almost unbelievable for me to see. People were paying all their debts down. Then what happened? The government printed a bunch of money, dropped interest rates to close to zero, and boom, look what happened here. As we travel up this part of the roller coaster ride, we keep seeing people are spending more as more credit is issued, as incomes go up, because the pandemic forced rates to go up because nobody wanted to work. People are making more, they're getting able to borrow more, they spend more. Once a luxury, now a necessity. And that brings us up to pretty much right where we're at. Now, if I were to pull up defaults of credit cards, Stephen, I don't know if you have that chart, credit defaults, what we'd start to see is that default rates are starting to go up tremendously right now on credit cards, because we're at the end of the boom cycle. We know the government's not going to print any more money, so the hand that fed the banks actually isn't printing any more money for the banks. There we go. Look at the default rates. There we go. Look at, remember, that was when people were paying it off. Look at the default rates right here. Okay. Anyone see a trend? And if we go back and we look at any of the other default rates, how about 2008? What happened after 2008? Default rates skyrocketed. And we could go back in time. We could go back to the early 2000s. We could go back into the 80s and 90s. We can look at all the other recessionary periods, and the same thing happens every time. Just trying to paint a picture here of what's happening here, folks. All right, so everybody understands this piece of it. I want to explain fractional reserve banking. This is kind of a little bonus session, but I think it's important for all of you to understand the simplest form of fractional reserve banking. This is you. You put $100 in the bank gives you 1 to 2% interest. Okay, so you put that money in there. The bank has to reserve $10 of your 100, but they're able to lend $90 out to Jill. Jill takes that $90 as a loan at 5%. Remember, they're paying you 1 to 2. They're charging Jill 5. She takes the $90, buys a pair of Nike Air Jordans from John. John now takes the $90, puts it in the bank. The bank's able to then take 9 of that 90, started with 100, okay? 9 of that 100 is, and they get to then lend out 81 more dollars. So they started with 100. They literally out of thin air created 90. So we had 190. That 90 created another $81. Then they take that money and they give a line of credit to Billy at 10%. Billy takes the $81 and pays off Visa. They take the Visa, the money that paid off Visa costs Billy 20%. Billy's making payments of 20% to Visa. So he said, all right, well, a loan from the bank is cheaper even at 10% than Visa's 20, so they pay Visa off. Visa deposits the money. Bank creates $73 out of thin air, reserves $8. They rinse and repeat this entire thing. They slap a little placket at the bank that says FDIC guarantee of $250,000. So the bank keeps records of all these loans, tracks all these loans, and also services all these loans. But your $100 becomes $1,000 to the bank. How many of you would love to be able to just do that? Take 100 and turn it into 1,000 through that process. Wouldn't that be pretty sweet? And just rinse and repeat that all. 100, then 90, then 81, then 73, 271, 271, literally fiat money. Well, what we teach every single day is how to become a bank. You can't create money out of thin air, but what you literally can do is mimic exactly what a bank does every single day. We're going to cover that in a second. Let's get back to the Great Depression. This chart right here shows these cycles a little bit better. There's the boom and the bust cycle, commonly also known as the buy and the sell cycle. Also, what we must understand is we must understand how in today's world and how back then the Fed or the governing powers would react in these periods of time. There's only really 2 different options. Now, I had to write these down because I think it's really important for you guys to understand this. I also forgot a really important thing. As that whole boom cycle is going on and more people are borrowing money and spending more money and making more money, what is also happening? The price of goods and services are going up. Because as people make more, they can spend more. And as people can spend more and people can make more, the cost of all of it goes up. Sometimes interest rates go up, sometimes they don't. But at just sheer inflation is the cost of goods and services are going up. Or in today's world, literally the money's being worth less. So that's typically how it works. So to create a boom cycle, what the Fed typically will do with one of their levers is they will decrease interest rates. So what would that make you want to do? If rates were really cheap again, like they were a couple years ago, what would you want to do? You'd go borrow as much money as you could, right? If you could borrow $1 million, okay, at 2%, and you could take that $1 million and put it into a T-bill at 5%, I mean, all of you would do that, right?
Dave Ramsey wouldn't.
Exactly. We played a video earlier of Dave Ramsey. He wouldn't take the debt. But I mean, all of you would. So if the Fed drops interest rates and prints more money, what does that do? That makes us all spend more. It makes us all use more. It makes the economy grow. It makes inflation grow. Sound familiar? That's just one of the different things that they can do. And during that period of time, we all, not just excluding myself, we all feel a sense of security. We all feel a really strong sense of security because we all feel like we're rich. Our house went up in value. How many of you had your house go up in value? Put I in the chat. Last 5 years, has your house gone up in value? 100% of you, unless you bought your house last year or the year before, everyone on here says yes. How many of you have watched your 401k go up? Your stocks, your mutual funds, all of your investments have gone up, right? You've watched this single-handedly happen. Well, that's because money was cheap. They kept interest rates historically low. Steven, do you have the Fred interest rate one? But they kept interest rates low and they printed $5.2 trillion. And this created this right here, Fed funds effective rate. Now, if I was to spend the time and have you really dissect this, what you would see is the same thing happens right before a bust cycle every single time. The effective rates go down. You can see it right here, okay? After the dot-com crash in 2000, what happened to interest rates? They got pulled almost to zero. Then they rose back up right before the Great Recession. What happened? There's 2008. They fell down again. Right before the pandemic, what happened? They fell again. And, well, here we are, 2023. Yeah, I don't know if we're really quite there yet, but we can see we've had a big increase in interest rates, the steepest of any of the other ones on there. So now keep this chart up. The second thing that the Fed can do is they can raise rates. Now, if they raise interest rates, what happens? It makes things more expensive. To buy a car is more, to buy a house is more, your credit cards go up, all things go up. And when your cost to borrow goes up, price of goods goes up and it slows things down. Come back over here to 2008. Okay. You see what happened after the Great Recession? No, go after that. That was high rates. They dropped interest rates low. See how long they kept interest rates low? I just want you to really take note of this, how long they kept interest rates historically low. And then they started raising them in 2000, late 15 into probably 2000 or 2019. If you guys remember this, I remember it like it was yesterday, but that was a period of time where the Fed was trying to get rates back up, but it almost stalled the economy and they very quickly pulled rates. They started to reduce the rates or flatten the rates, and then they dropped rates when the pandemic hit, like a rock, okay, right there. It's like Chevy's commercial, like a rock, but the wrong kind of rock. You don't want your Chevy to do that. So they can raise rates. Second thing they can do when they're raising rates is they can suck money out. And how they do that is the balance sheet, okay, of the Fed's balance sheet, they have bonds on there. Because like I was explaining, the banks create notes, okay, and then they basically pledge the note to the government. Those are bonds, IOUs. The US government does the same thing. When the US needs money, the Fed prints it. Well, the Treasury prints it, the Fed authorizes it, and the Fed basically exchanges dollars to the government in exchange for debt. So they hold a lot of debt, trillions of dollars in debt. Right now, here we go, total assets, less eliminations and consolidation. Notice how we're using the same economic data here, folks. So what is the government doing right now? They're unwinding their balance sheet. They're selling off their balance sheet. 2008, look what happened right after 2008. The same freaking thing. They tried, but then they couldn't pull it off. So they just kept adding after that period of time until now. That's $95 billion a month that you're seeing right there on that downward slope, and it won't slow down. So here's what happens, okay? And I want you to pay attention really, really closely. This whole printing path, this whole boom cycle, this whole cycle that we've lived in now for 12 years. It's like a long, long hangover. We've been living in this world for a long time. It's been like this. And nothing really exposes itself during a boom cycle when all is good. But when we start the downward cycle, the bust cycle, or the sell and panic cycle, as I like to call it, things start to get exposed. All of the damage that was done during the boom cycle starts to, it's kind of like, you know, when you throw garbage in a lake, but then the lake's water kind of evaporates and eventually all the garbage starts to show. That's what's going on here. So the Fed's pulling all the money out of the system. It's lowering the money that's available. It's raising interest rates, making it difficult. All the garbage is starting to get exposed. So the damage done in the boom cycle is now what you're seeing. This is all theory. Okay, so there's two parts. The reality is what I'm showing you with the Fred data. So there's one really cool Fred data that we can look at, and that is the housing bubble. See, boom cycles create bubbles. Bubbles all burst. You've all tried blowing a bubble gum, or you take bubble gum and you blow it. You remember that? Eventually the bubble gets big. Oh my God, look how big it is, but it bursts. We always know it's going to burst. When you're blowing up a balloon, sometimes it gets so big, you're like, oh my God, I can't believe this is blowing up. Oh my God, this is going to hurt. And then it pops. All bubbles pop, every one of them. We are living in a period of time this is the reality, folks, where we literally have created the biggest bubble in our economic history in this country. And that bubble will burst. Now, housing will not be the first part of the burst, okay? But I can show you if you've got it up, Stephen. Do you have the Fred report on housing? Let's see that one. Brad, I'm going to cover why your rent went up. We're going to hit that. So here's housing. Let's think about housing here, right? Remember all the other charts, and I can't lay them one on top of the other, but it would really paint the picture I'm trying to explain. Rates have been historically low. Interest rates have been historically low for a very long period of time. And then interest rates started going up very quickly. So if you own a house, and you own the house in that period of time when interest rates were between 2 and 4%, but now you can't get a mortgage for under 7, are you going to be motivated to want to sell your house, even if you can get top dollar for it? No, not unless you got to move because of a job or something happens or you can't afford it. Like, you're just not going to. So when you talk to realtors and some real estate investors and they say, oh, it's just going to keep going, buy real estate. This is where I just got to warn you a little bit. So why does real estate keep going up and up and up? Is it really that there's so much demand that they just can't build enough houses? Well, that's a small part of it. But the only reason there's so much demand is because people don't want to sell their houses. People are staying put because it doesn't make economic sense for them to sell their house and then move into another house. There you go. That's a really good one. Now, this is an interesting chart because this tells a little different story. But the other reason is housing is a delayed reaction. Basically, housing is a lagging indicator, indicated by right here. When the whole stock market goes down, housing doesn't right away. It's lagging 6 to 9 months. So you can start to see here the median sales price is starting to go down, but now it's coming back up, which is quite interesting. Why is it coming back up? Well, didn't you just hear that they're going to drop rates in 2024? Speculation, people got excited, rates came down. So now all of a sudden, and this is very current data, now all of a sudden you're starting to see prices go back up. Is that good or bad? Well, all that means is what Brad said, his rent keeps going up. Why would Brad's rent keep going up? Why would everybody's rent keep going back up? Isn't it because housing is too expensive for the majority of people to afford? So because they can't afford housing because interest rates are so high and, well, prices are high, so therefore they resort to renting, and renting goes up. And now as all of this stuff happens, okay, as all of this stuff continues to kind of flush through the system, when you start to really understand the problem, like they would have seen in 1929 or 2023, is when necessities in life seem really expensive, okay? So when pricing of your house gets to a point where most people can't afford a house, so therefore they have to rent. When rents are so high that most people have to downgrade to an apartment that isn't suitable or isn't what they want to be in. Difficulty is when food prices are so high that it's actually hard for a family to eat a good meal. Now, when you look around, you go to the grocery store, you go all around, aren't all those things really expensive? But yet still, and I'm really focused more on 2023, isn't it bizarre how people still have the money to go out and act rich with the Rolexes and everything else? Now, here's a pretty interesting thing, and I did not know this until I was doing this preparation for today's training. And there is a point of what I'm going to get to with the training. I'm going to basically, the main point is 2024 might be the greatest year in history for all of you to become your own banks, because I'm explaining exactly that. I'm painting you the picture.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Did we show that one yet? Did we show how much money they printed or how much the US government's debt is? It's 34 trillion. So do we have either one of those charts?
Yeah, I've got both. Let me get them up.
Let's do the money printing.
Money supply.
Here's money supply. Now, I want you to look at this. Money supply is essentially just as it sounds. It's M2, money supply. And you can see all the money supply has been going up. Look at this. I mean, how far back can this thing go? Can you go back to 1929?
Just to 60.
Okay, but just look at that chart, folks. What does it show? It shows money supply going up and up and up and up and up. Hence why the standard of living has gone up and up and up and up and up. But what is going on right now? The money supply is going the opposite direction. Money supply is going the absolute wrong direction for growth. You can't sustain future growth when money supply is actually drying up and going down. And this can be seen when we look at all the things out there that just a few years ago were skyrocketing. You couldn't even get them. Let's talk about cars and let's talk about Rolexes. But first, before that, let's focus on our amazing government. The dude in charge, is now got our national debt to about $34 trillion. We're celebrating that this morning because why not celebrate it? I mean, we're setting records every second of every single minute of every single hour. Oh, yeah, and we're getting some awards too. There we go. Winner is the U.S. Federal Reserve. Winner, winner, chicken dinner.
Presented by Charles Ponzi himself.
There you go. Charles Ponzi presenting the award right over there to Chairman Powell. So remember, during these boom times are when we create problems, but during the bust times, now you start to see a lot of these uncovered, which is Ponzi schemes. You start seeing all these things come to light. But I also think it's really important that we focus on kind of what I did not know is the misinformation, I call it the malinvestment, the abundance of supply, and basically the misguidance to all of us. All of you see these things, right? Every day. You're seeing every one of these things. But have any of you noticed, and James is in the office today, and James knows cars well. Have any of you have noticed the deals there are with cars right now? I mean, used cars. Used car prices are coming down. There's a lot better deals. There's a lot of cars out there for sale. And if you look at brand new cars, and I don't think I have this one up, but I just was kind of looking through some of them, but I looked at a couple. One of them was Jeep. Okay, I looked at Jeeps because there's a lot of Jeeps on the road. And depending on the kind of Jeep, not so much the Jeep Wranglers, but if you look at the Wagoneers and the other ones, there is a crazy amount of deals out there. Some of you might say, oh, it's year end. There's always deals. Maybe, but not like this. Some of these vehicles are $20,000 off. Have you seen this, James? New car prices are there's deals everywhere. Why would there be crazy deals on cars when just a few short years ago, you couldn't even get a car? If you walked into the dealership, they'd kind of laugh at you. Ha! You want a new car? Get in line. But now all of a sudden, inventories are starting to climb because everything's catching back up. Now, we're not back where we were, but you see, inventories are really high. At the same time, interest rates are really high. Therefore, there's an oversupply of cars, but not just cars, Rolex. So there's an article that I saw, and it was in this technology article, and it basically was saying that Rolex prices are dropping. Come on, folks. I thought Rolexes are supposed to always hold their value. Well, that's not what this chart shows. If we look at the last year, Rolex prices are going down, down, and down. Look them up. But not only that, they're easier to get. Now, how many of you follow Rolexes on here? Put Rolex in the chat. How many of you know a guy or a gal who knows how to get you a Rolex and they can get you a great deal on it? Doesn't it just seem strange how there's all these people now who are like now Rolex, not dealers, but sourcers? They can find you the best Rolex at the best price. And you can't get them anywhere else. Because we all remember just a couple of years ago when you certainly could not get a Rolex. And if you wanted one, you'd have to way overpay. Hell, if you wanted anything, you'd have to way overpay. But you see, everything's coming down. So now the price of necessities are going up. The price of luxury items are going down. When I asked you earlier, what did it look like before the Great Depression hit? Exactly like this. All of the signs point to one place, and that is that the economy is entering the next cycle, which is called a deleveraging cycle. Housing and food is pricey, affordability issues, all these things, delinquencies. Right now, I looked it up, 2.77% and climbing, our credit card delinquencies. That's higher than the peak of 2020, okay? Banks are tightening. This is the last piece of this. Have any of you tried getting a loan recently? Anyone tried to get a loan recently? Got 150, 160 people on here. Someone has to have tried to get a loan recently. Anyone? Okay, Will, was it easy to get a loan? Did it seem like the bank was eager to lend you money? No? Anyone else try to get a loan recently? I did. How many of you think I make a decent living? I think I make $1 or $2. It's all legitimate money. W-2. Yeah, I pay myself a W-2. Yes, I do. Salary. Not only that, I got a lot of 1099s, got assets, have no debt except for my primary house, which I'm paying down. So how many of you think it would be difficult for a guy like me with I'm just under an 800 credit score. I got high income, low debt, a perfect track history of payment. I've never missed a payment, never defaulted, never even once. How many of you think I could walk into any bank and I could just get a loan? Let's say I don't want just a loan. Let's say I want a home equity line of credit that would be collateralized by a paid off house, not a house with a mortgage where the bank's in second, a fully paid off house. And all I want is $70,000, and I'm willing to pay the 9% interest. How many of you think that should be a pretty easy thing for a guy like me to get? Well, you would think wrong, because it's not easy. Me and Brandon here in my office, who worked for a bank, went through probably one of the most frustrating, idiotic experiences I've ever gone through in my life, probably a lot like Will. I could not get approved for a home equity line of credit on my mom's house. Oh, and by the way, the home equity line of credit that I was applying for was a home equity line of credit that I already had for the past 10 years or so on my mom's house that I've used and paid back, but it was expiring and maturing. And I just wanted to just re-up it. Hey, kind of want to just re-up this home equity line of credit. We had to send them everything. I mean, Brandon was exhausted just looking up all the stuff. They wanted everything. And at the end, they said that they wouldn't give me the loan. And I'm not going to get into specifics because it will piss me off and it would piss you off too. But the reason they gave me was so ridiculous that I know for a fact it's just the bank isn't lending money. Banks are tightening. Is there a Fred report, the net percentage of domestic banks tightening? Did you try to find that one? Yeah. This would be interesting. Net percentage of domestic banks tightening. So remember I said the Fed is unwinding their balance sheet, maturing their bonds at a tune of $95 billion a month, taking more money out of the system as he's pulling up this chart. Not only that, if you do some digging, you'll find that there's 700 US banks right now that are exceeding the FDIC guidance, the bumpers that the FDIC puts in. 700 banks right now are far in excess of the concentration of commercial and business loans by FDIC guidance, which means those 700 banks are in risk of becoming insolvent or not having the guidance of FDIC, which basically means they cease to exist as a bank. They go into receivership.
More for commercial and industrial loans here for large to middle, but it shows the point though.
It doesn't matter. We already did credit cards. We can look at car loans, but just look at this. This is banks lending. Look at that line going down. But then look at the line in 2020. What happened then? Same thing. What happened in 2008? Same thing. What happened in 2000? Same thing. We go back to the 1990s or late 80s, and we look at that recession. Every other period of time, the same thing has happened. Folks, listen. Remember I started with the story of the story of Kennedy getting his shoe shined and the shoe shine boy giving stock tips, and Kennedy listening to that and saying, hey, maybe this is time to sell. And he did. What more do I have to tell you? What more do you need to see? What more do you need to hear to understand that we're not soft landing? Maybe their definition of a soft landing is like their definition of a recession. God, is that Snoop? Sure, kind of looks like Snoop, but it's not now that you look at it.
Got everybody balling out there though right now.
I think one of the funny things, here we go, bling bling, Lamborghinis and rings and gold and diamonds. Yep, don't be fooled. Don't be fooled, because we are right on the cusp of the same scenario we were in 1929. How it's going to shape up, I don't know. But how you all act and react to what I just told you, and I know I probably could have done it a lot shorter than I did. I probably could have done it a little bit more eloquently, but basically you just need to understand that all the stats are in. And when you really think about that initial drawing I did, I was showing you productivity growth. I was showing you short-term debt. Okay, and I was also not showing you the long-term debt cycle. But right now, folks, we are at the end of all of them. We are entering a deleveraging period. You're already seeing it, which means the price of assets that you own will soon start to go down. That includes your mutual funds, your ETFs, your 401k assets. That includes your car. That includes your house. Housing is a bit funky right now. I don't really know how to put my finger on that one, but I just keep saying it's a lagging indicator. The markets are up. Why are they up? It's total, complete and utter speculation. Complete and utter speculation. And now the markets are realizing, whoops, maybe we overshot that one. But that's what happens in a boom cycle. People make misguided information or use misguided judgments to information that they get. The Fed opened the door for 3 rate cuts, and then the markets priced in 6 rate cuts. Why? Let me ask you this, folks. Why would the Fed drop rates in 2024? Can anyone tell me? What would be the only logical reason the Fed would drop rates in 2024? An election, great answer. Yeah. They drop interest rates, stimulates the markets, stimulates the Wall Street pundits, which is really just Congress. We talked about this earlier, get the system working again. Wait, Ken, but the system is working. The system is working fine. Prices of things are still going up. Stock market's up. So the system isn't broken yet. It's been broken, but it hasn't stalled. Yeah, yet is the key word. Anyone else know why? A mirage? Okay, what else? Somebody's gonna, yeah, there we go. Jordy said it. And all that stuff that I showed you a second ago, when was it certain in those charts? Pull up that interest rate chart again. When was it certain? When did the Fed always drop interest rates? Think back to the last time when they lowered rates, right? 2020. Why? We're in a recession. I know the dude and the powers that be. I'm trying to stay away from politics lately, but they basically said that the recession we were in, we weren't in. So every other period of time, when right there, if we just look at every downturn, when did that happen? 2008. What happened in 2008? Great Recession. What happened in 2000? .com crash. What happened in 2020? The pandemic. What's about to happen now, folks? Can you not just see it? What's going to happen? They're going to drop rates, but why are they going to drop rates? Probably a mix of all of those things. Just put them all in a blender and hit start, but mostly because we will be in a recession. Yes, the election will play into some of that decision, but just look at the charts, folks. You don't even need to listen to me anymore. Seriously, I don't care if any of you listen to what I say. Just look at the data and look at the facts. The Fed funds rates, the M2 money supply, the inverted yield curve, everything you see going out into the wild, which is basically out your front door. Okay, what do you see out there? Fake riches. You see a lot of people spending money they don't have to buy things they don't need to impress people they don't even like. You've heard that one before, right? So what is the conclusion? What am I driving home today? How many of you think that this might be one of the best times ever to be your own bank, to take back control of the banking functions in your life? How many of you feel like this would be a period where you'd like to be in control, where you'd like to be out of debt, where you'd like to basically be able to call the shots instead of sit there and ride the roller coaster down? Do you think Kennedy was excited when he sold his stocks and watched the entire market crumble when he was sitting on all of his gains on the sidelines? I don't know that to be true, but it's a great story. How many of you want to be Kennedy? How many of you want to be sitting on the sidelines waiting for the great show to begin so you can literally just go in and cherry pick whatever investment you want 50% off? Wouldn't that be great? Exactly. No time like present. But see, here's the thing. The problem we have is we have blinders on. I was reading an economic report. So this one economist talks a lot about treasury bonds. I get quite a bit of info from him. And I was reading one of his, he's got like this mailbag where people send in all their questions. And this one guy was literally, I don't know how he answered this nicely. I wouldn't have. But this one guy was asking, hey, when should I get back into treasuries? Now, this guy, just in reference, had obviously owned treasury bonds, but then sold them because they kept going down. Well, no shit. When interest rates go up, price of bonds go down. So you just keep buying. You just dollar cost average in. You don't buy them and be like, oh, it didn't go good. I'm going to sell it at a loss and just wait to enter at a better time. And then he was asking this economist, hey, when will be a good time to buy back into the treasuries? So let me just describe this. So let's just say this, I should have done that in red. Okay, this is price of any investment. Okay, any investment. Can anyone tell me where you want to buy? Hold on, I'll help. Anyone want to buy here? Who wants to buy there? Anyone? Is that where you want to buy? Who wants to buy there? How many of you want to buy here? Buy low, the bottom, right? Every one of you said the bottom, and that would be the right answer. You don't want to buy up here at the top, okay? You don't really want to buy in the middle. You want to buy at the bottom. You see, what I didn't do is I didn't tell you where the bottom is. Now, let's just say this keeps going down. What do? Do you panic and do you sell? Because that's actually what people do. They sell down here because they can't handle the heat in the kitchen. They think they made a mistake 3 feet from goal, because then what's it do? It does this. And then right here, when they sold here and lost money, then when it gets here, notice how this is almost exactly where they got out, okay, or where they bought in. This is right here when they're starting to say, hey, when should I know to buy? Well, you should have bought here, or you should have bought here, but you shouldn't have sold. And now you're wondering where you should buy. Oh, I'm just going to wait and see if it's going to keep going up. I'm going to just wait and see, and I'm going to see if it's going to go up. I'm going to wait and see. Well, I think now is a good time to buy. And then it does this. If you let your emotions get the better part of your judgment, then you're absolutely never going to make money in the markets. But it's very simple. It's buy low, sell high. But where is low? It's a moving target, folks. You're never going to get it right. You're never going to nail it. Buying low to me was here and 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 all the way down. And then here and here and here and here. And why? Because it's called dollar cost averaging. All I'm doing, folks, with pretty much any investment, but only investments I'm buying right now are treasury bonds and treasury bills. I am dollar cost averaging in to these. And I do the same thing with Bitcoin, but I sell the Bitcoin every time it goes up. Okay. So the treasuries I don't, because I know that when the Fed drops rates, okay, they drop rates, I know this is the impact. So really all I'm doing is I'm just waiting, and I'm going to sell probably somewhere around right here. Why here? Oh, Chris, why wouldn't you sell there? Because you're never going to get there. You're never going to know what the top is, and you're never going to know what the bottom is. So if I buy it here and I sell it here, did I make money? Yeah. How much money? Enough. It doesn't matter how much. You need to have a goal when you invest. But greed is what will force all of you to lose money.
I don't know if this is off topic, but I can't find, how does a bank create and own life insurance on people without the person being insured knowing? Just the question that I'm itching to get scratched.
Oh, here, I can scratch that easy. Every person does know. So how do banks? Bank's an institution, okay? X marks the spot. This is a bank. Bank has tier 1 capital, 10%. We already went over this. Bank needs to put that in safe, guaranteed places. Treasuries, okay, and BOLI. All of you should honestly do yourself a favor and look up BOLI in Google, or go to fdic.gov and type in BOLI. And you'll see every bank in the country that owns them. It's trillions and trillions of dollars right now. Banks own a bank-owned life insurance, which is whole life. So the money goes there. But BOLI is life insurance. It's actually a version of whole life. It's a specially designed and engineered whole life. Does that sound familiar? Look it up, folks. You guys can do your own research. It is a specially designed and engineered whole life, but they call it BOLI. Can any of you on here buy BOLI? No. It is exclusively for banks because of the tax advantages. Specifically designed and engineered for a bank, which means none of you can buy BOLI. But can we mimic a bank? Can we act as if we're a bank? Can we mimic how a bank builds these? That's exactly what we do. But let's go back to a bank. A bank, to buy a life insurance policy, needs a what? Needs a life. So we need a body. So by the rules, what does a bank need to have? An insurable interest in one of their people. What's an insurable interest? Well, by the definition, an executive. So an executive of the banks. What made them an executive? Somebody said you're a vice president. And I forgot, they got a little pin that they put on their chest. You're an executive. Great. So now the insurance company says, awesome. Well, since you've got these executives called vice presidents, we can insure them. So because the bank buys in volume and buys huge sums of BOLI, the insurance company gives them guaranteed issue policies, meaning that this individual gets insured whether they're insurable or not. There's no underwriting. Pretty nice. Okay. So now the bank insures this person. So they got themselves a life insurance policy, okay, on this executive. The executive has to get something as an equitable value from this transaction. The bank cannot buy a life insurance policy on their vice president without giving them something as an equitable exchange. So what do they give them? Well, they give them a fully paid up life policy. Let's just say this is a high level executive, so they give them $250,000 in death benefit. How much money did they put into this policy? Let's call this one $5 million. How much death benefit do you think $5 million buys? Well, let's just put it at 15 million. It's probably more, but we'll do 15 million. So they put 5 million into the life insurance policy. If this employee dies, there's a death benefit of 15 million. But you see, because the policy is specially designed and engineered, how much cash value does the insurance company give the bank? About 90%, sometimes a little more. Very similar to the policies we design, except for we can't do guaranteed issue, only banks can, okay? But about 90%. In the next year, how much do they have available? More. In the year after that, probably all of it. So banks are buying life insurance on executives, but they have to be an executive they have to be an executive like a vice president, and they have to get something, a fully paid up life insurance policy, maybe a deferred compensation plan. Maybe they use the life insurance to offset benefits provided to the employee. Now, here's the catch. I know I'm going long on this, but this is so important. Here's the catch. When the vice president terminates employment, they no longer want to work for this bank. Does the employee get to take the benefits? No, not at all. Unless the bank fires them, then they have to give them some type of a benefits package. Okay, but they don't take the benefits. So now the insurance company's got this policy, but they no longer owe the $250,000. They no longer have to pay health benefits. The deferred comp, if it was vested, probably stays. So we'll leave that there. How'd the bank do in that transaction? How many of you want to be the bank in that scenario? So why aren't you? Why aren't you insuring everyone in your family? Why aren't you, as the breadwinner in the family, going out and literally mimicking a bank? If this is you, okay, why aren't you going out and taking out a policy on your daughter like I did? Or how about maybe you got a son? Take a policy out on your daughter and your son, all your kids. How about your wife or your husband? How about take a policy out on them? How about mom or dad? I mean, mom or dad are older than you are, right? As long as they're insurable, why wouldn't you take a policy out on your mom or dad? I mean, life expectancy on them is far, well, we hope or think, far less than a wife or a husband, far less than a daughter or son. So when they pass away, what happens? A death benefit pays back to you if you're the owner. What happens when the wife passes away? Death benefit goes to the kids. Or if you're really smart, you do what the Rockefellers do and you set up a family trust and you have all the money go to the trust so that the kids don't squander the money in the next generation. Do you see what's happening? Why aren't you doing what a bank does? I'll never understand sometimes why people don't want to become the bank or why they find reasons not to punch holes in it. Listen, like, folks, let me be real with you. All we do, and sometimes I feel bad that like this is all we do, is we just tell you to do exactly what a bank does. Because we know if you walk into this bank, and you say to the banker, I don't care if you're a private banking client or just a normal client, and you say, hey, listen, I have some money that I want to put on deposit in this bank. Bank will be excited. And then you say, but I only want to put this money that I have saved the same place the bank puts their most valuable tier 1 money. Can you help me? 100% of the time, the answer is no. Chances are your bank doesn't even offer whole life insurance. Chances are if they did offer whole life, they would not know how to design it the way that the bank's policies are designed. Chances are if you walked in, the bank would literally not even know what the hell you're talking about, because all the bank wants to do is sell you a CD, sell you an annuity, sell you an investment advisory account where they charge you a fee. Yeah, Will said facts, probably because Will's been into the bank asking for some of that bully, and they said, I don't know what you're talking about. If banks are putting that much money into bully, if that's one of the #1 places banks put money, why wouldn't the bank, if they have your best interest in mind, offer you a place to put your money that mimics where the bank puts their money? Why? Why don't they? Could it be because the bank can't make any real money on it? Could it be just because the bank doesn't know what it is? But wait, they're buying it. Yeah, but it's different. See, these are the questions that you start to uncover and you start to really ask yourself when you start going deeper and deeper down the rabbit hole of becoming your own bank, the rabbit hole of the infinite banking concept. And it's very simple why any bank or any person would want to do this. And I'm not going to get deep into the infinite banking concept, but all of you have some form of savings, okay? You save money. And some of you save it weekly, some of you save it monthly, some of you have some type of a systematic savings plan, some of you just don't save, and then when you get windfalls, you dump it in, but you all have savings. And where is that money going today? It's going to a bank or maybe a 401k. That's where your money is going today. Almost everybody. So all we're literally proposing you do is just mimic a bank. Instead of putting it in their bank, create a system of private banking where you are the bank. So you're going to put it in your bank, but your bank isn't a bank at all. Your bank is an insurance company, a mutually owned insurance company that pays dividends. And to get the money in the insurance company, we need to go through a product called whole life. That's all we use for the infinite banking concept. Why do we use whole life instead of IUL? Whole life has a level cost of insurance. Whole life can be modified because that's why banks use it. And whole life is the longest going life insurance product that there is. So it has a track history. But not only that, it has a level of cost of insurance and guaranteed interest, key word. So now you put your money in your bank. This isn't its final resting place. Matter of fact, quite the opposite. As soon as the money goes in here, what we want to try to do is find somewhere else to have that money go to work. So let me ask you this. If you were a traditional bank and you were paying your customers 3%, would you lend money, because those are opportunities, would you lend money to people at less than 3%? If you paid somebody 3%, would you lend that same person money less than what you paid them? Of course not. You'd charge probably double. So let's just say if you were paying 3%, but you would lend to them at 6%. Why? Because you'd make a spread. Okay, so why do we do what we do? So now the numbers are a little different for this. The insurance companies pay, I don't know, I'm just going to round, go in the middle. It's between 5% and 6% with dividend. Let's go 5.5. And the insurance companies allow you to borrow money from their general account. Essentially, they're letting you borrow part of your death benefit while you're living up to the amount that you have in cash value, okay? Because this is your collateral, so the cash value is the collateral. This is no different than what a bank does. This is why sometimes when people don't understand this, I just say you just haven't watched the video. There's nothing hard. This is exactly what you do today in reverse order. You're not putting the money in their bank, you're putting it in your bank, a specially designed whole life. You're borrowing from your whole life policy at a rate lower than what the insurance company is paying you, exactly like a bank does it. And then you're sending that money to go out and do something at a rate higher than the borrow cost. If the insurance company is going to charge you 5%, how much are you going to send the money out to work for? Anything 6% or more is my rule, but you're probably actually going to go and probably do something like 12%. Okay, so you could go to the Fullers, Rob and Nicole Fuller, and you could lend money on their real estate deals at 12%. If you're paying 5% and they're paying you 12%, what's the spread? Okay, 7%. So you're making 7%, but then how much? So let's just use 100 grand. You got 100,000 bucks in your policy. You take 100 out, you give it to the Fullers. They pay you 12%. The insurance company charges you 5%. You make a spread of 7%. Some of you are like, yeah, but if I did that from a bank, I'd make the full 12%. Hold on. How much was the insurance company paying you? 5.5% gross. How much money is in the bank, even though, or in your bank, the whole life, even though you took 100 out? Well, 100, because you didn't take your money. You used the insurance company's money. They advanced you part of your death benefit. But now, to be a bank, you can't cheat yourself. You're making 12%. You're making a spread of 7%. Where are we going to send the money after we make it? Where are we going to send it? Are we going to send it to Bank of America? We're going to put it in a traditional bank? No. You're going to take the money you make and you're going to put it back into your bank where it came from. Duh. And why would you put it back in your bank? Why would you put it in somebody else's bank? Because when you put it back in your bank, are you not reducing the amount of the loan? Which, when you reduce the amount of the loan, if we go from 100 down to 90, it's owed to the insurance company, and they're charging you 5% on 90, but you're making 12% on 100, and you're making roughly around 5.5% gross on 100. See what I'm saying? Why would you not want to pay the loan back? Why would you not want to continue every single month to pay these loans down? Well, the only logical explanation for why you would not want to pay your bank back, it would be, well, I don't want to pay it because I'm not going to have that money to use. I'm not going to give the bank the 12% I just made because I don't want the insurance company the 12% I just made because I want to use that 12%. Great. Every dollar that you put back into the policy as a loan repayment is money you have to use the next day. Because remember, all you're doing is borrowing your death benefit. So if you repay your death benefit and you increase your capital, your cash value, you always have more money to lend and you'll always have more money. Every dollar you put in is money you have to use the next day. Now, again, I know for some of you, if this is your first time, a little bit of that was over your head, but that's okay. We got lots of videos that teach all of that. I just want you to understand that, like, 2024 is going to be an interesting year. Is it going to be the next Great Depression? I don't know. Some say it will be. Is it going to be rough times? I would certainly say so. Is it definitely going to look different than it does or did in 2023 and 2022? I would say so. And are some people going to lose a lot of money and get hurt really bad? I would say so. Is that going to be any of you? All 143 of you? No, shouldn't be any of you. But if you don't apply what you just learned here today, if you don't learn from the past mistakes that people have made, you will continue to make those mistakes over and over and over until you learn. You reap what you sow. Like so, go out there, and if you've got gains in your stock portfolio, gains in your 401k, take them off the table. Unless you want to give them back. Maybe you need a tax write-off. Hell, I always tell people, hey, look, there's always got to be someone out there that's got a bunch of gains in their stock portfolio and they don't want to pay taxes. So just let the stock go all the way down to it's less than what you paid for it and then sell it. And then you got a tax write-off. Great strategy for stupid people. None of you are stupid. So, Stephen, what questions do we have now?
Oh, yeah. And you talked about Walmart. Somebody was commenting.
Oh, Walmart.
Remember when that happened? They got sued?
Yeah, Walmart got sued because they were doing what banks do. They were buying policies on all their employees, called COLI, company-owned life insurance, but they weren't giving their employees anything. That's kind of a thing that Walmart would do, isn't it? It just fits the bill. And then
their defense was we put billions of dollars a year into like training and recruiting. So it's like, come on, they got
we trained you how to put price tags on these boxes and on these toys. Come on, that wasn't enough. That wasn't economic value. We exchanged.
Yeah, roll back pricing on the
husband passes away. Walmart gets $2 million. The family is desolate, has no money. And
Rick Smith said, with what you just said about the HELOC on your mom's house, should we be concerned about the banks, credit unions decreasing our current HELOCs? If so, what are your thoughts about maxing it out and keeping the money safe in another institution?
Well, it's interesting. Like, some of you have been around this campfire for a long time. So some of you might remember during the pandemic, some of the trainings that we did. This is really early on. And yeah, the cup game. So what we basically did is all of us, so myself, Randy Garn, a whole bunch of people, we would get on these Zoom calls, these trainings, we'd open them up to the public, and we would tell people, like, hey, one of the things I would suggest doing is taking all the money from the lines of credit that you have, take them out of the bank that gave them. So let's just say this is the bank that gave you the loan. You take the money out of this bank that gave you the loan, you put it a little bit in this bank, a little bit in this bank, and then a little bit in this bank. So you spread the money out amongst these different banks, but the original bank that gave you the loan you don't have any money there for them to take back. Now, can this bank ever take back the money that's in these other banks? No. So now what can you do with this money? You can buy opportunities when prices go down. You can deploy that money into things when prices go down. It's the cup game. I don't know if right now is when you should do that, Rick. It might be a bit early because at 9% interest for most HELOCs, you'd be paying a lot of interest on money and you really don't have anywhere to deploy that. Now, I mean, it would make sense if, well, I mean, actually you do, Rick. So like if you had a HELOC and it was 9% and you lent that out to the Fullers at 12 to 15%, that makes sense. And the bank can't take the money back. The banks will, mark my word, the banks will start calling, reducing, and freezing home equity lines of credit and lines of credit. Mark my word. I'll tell you the future right now. That will happen in 2024.
Our military friend, Will Smith. So what's up, Will? All right. So he said, I've built 3 to 5 year plans for investments and contemplating buying a house and a vehicle in that time frame. Any purchase would be earned interest paying for them. I have an IBC policy based on this, restructuring that plan to focus on strictly investing and postpone major purchases 24 to 36 months. Fair analysis, or did I miss something?
No, I think that's a fair analysis.
Yeah.
I would just play it, play it by the wind. I mean, I wouldn't rush into using it for that. I mean, I'd wait for things to settle.
Feeling FOMO for a home purchase before rates go down and everyone floods the market.
It's an interesting one, Will. When rates, I want you to think about this. When rates go down, it will more than likely be because times are rough, because times are hard, which means a lot more people than today will be laid off, will be out of work, will not have incomes, will not qualify for loans, will not be able to buy new housing. So what will happen to the price of housing, even though rates are going down? If I got to be a betting man, I would say price of housing will go down significantly. So Will, you got to really look at that as a two-sided, there's just two sides to that. So you think that when rates go down, the price is going to, go back up because everybody's going to flood the market. It will not happen like that, at least not quickly. My guess is the price will go down because of hard economic times, not because, just the Fed is like, oh, we soft landed this puppy. We're just going to drop rates and make everybody happy and get the dude reelected and make even more professional traders out of Congress.
Yeah, I agree 100%. They're not going to drop rates unless they absolutely are forced to, because they know dropping rates, it's going to cause all the issues again. They're going to have no more tricks left. So that'll be last case scenario. And when it happens, like Chris is saying, it's probably going to be a great buying opportunity. And you're in a position, Will, where you'll have a nice down payment available and be ready to take action on it. Unlike, unfortunately, a lot of people, I have a feeling. Brad says, if setting up a new LLC with multiple partners, can each partner put a COLI on each other, or is it better to put a whole life policy and take a loan to fund the new LLC?
COLI is whole life. So COLI just means the company owns it. So Brad, probably what you want to look up and Google this, and we can even put it in the chat right now. It's called, if it's just you and one other partner, do a buy-sell agreement, but do an entity purchase buy-sell. Stephen, can you write that in the chat? Entity purchase buy-sell. So what you're basically essentially doing is the entity is going to buy a policy on each of the two owners of the company, and the entity will be the beneficiary of those policies. So the company will own the policies on the two partners. The company gets to use that money any way they want. Okay. Now you might say, Brad, I don't want the company to own it. I want to use it. Great. Then do what's called a cross purchase buy sell, where you buy a policy on your partner and own the policy on your partner. Your partner buys a policy on you and owns the policy on you. And that way, then each of you are the beneficiary. So when one dies, the money comes back over to the other partner and buys out the significant other of that person. Because I don't know about you, but I don't want to be partners with Steven's wife. I don't want to be partners with anyone else, any of my other partners' wives. I just don't. I want to be a partner with Steven, or I want to be a partner with Greg, or any of my other partners, because those are the people that have the expertise that I need. Their significant other, although they may be smart, I don't want to be their partner. So I just want the money to buy them out. That's hence a buy-sell arrangement.
I'm sure my wife would be happy with that too.
Yeah, oh yeah, here's a check.
She doesn't want to be sitting on this webinar. She wants the money item out.
Here's a check.
James said, if I'm the only income earner and my wife is a homemaker, what would the premium amounts be based off of us for my wife and 4 kids?
Any amount you want it to be. We don't tell you how much your premium deposits are. You pick that. I mean, does the bank tell you how much money to deposit in the bank every month? No, you pick that amount.
Yeah, well,
lazy cash.
The kids are a little different. The kids can get 50% of what you
right.
have. And then your wife can get probably up to what you have, even as a homemaker. We would just write a cover letter explaining you want both parents covered. So we can help you with that, James. They own a business. Can we do that for can they do it for employees and contractors?
Not for contractors, no. You can do it for employees, but only if the employees are executives.
Right. Key employees. Yep.
Yep.
You have to be able to, what you got to do is you got to be able to justify that if that employee was to pass, that there would be a hardship on the company, until you can replace them or what that looks like. So an average everyday secretary, no offense, you could easily rehire that person and there wouldn't be a big hit to the company. So in the insurance company's eyes, that's not an insurable interest, but a key part of a business, a key employee, an executive of that company, that's a lot more difficult to replace. And that's where they would see that financial hardship. So that's the way to look at it. How do you set up a family trust?
Call a good trust attorney or call corporate capital. They got a good trust division.
Ryan, if you send me an email, I'll connect you with Corporate Capital, our friend Brent Carlson, and he does that for a lot of our clients and does a great job with it. I'll put my email in there for you. How do you lower your taxable income as a W-2 worker?
Well, Ryan, that's the $1 million question. It's very difficult. If your sole income is W-2, it's very difficult to lower your taxable income as a W-2 employee. That's the game. That's the riff, right? That's how they get you. They get every one of us to get W-2 income and work a job, and that's what they want, because that's how we get loans. And hence one of the reasons why I couldn't get a loan is I had not enough W-2 income. I was more 1099. So the only way you could do it, Ryan, or I think the smartest way, you could maximize your deductions, but you're only going to get to a certain point, would be to start your own company. Okay. Create an entity. Corporate capital can help you with that. And then have that company do something that has expenses. Like, let's say you want to go through a coaching program, you want to get education, have your company pay for all that education for you to get certifications and knowledge. That's all a write-off to the company. The company might show a loss, and then that loss can be carried over to your personal W-2 income and help you deduct that. Now, I'm not a CPA. I can't give tax advice, but consult with your CPA and ask them about, the relevance of whether an entity and a little side hustle business would help you.
Absolutely. It's one of the reasons I actually like the whole network marketing industry is, it can supply a business, a legitimate business to you, that if done right, can yield some tax savings through the right strategies. So, and, a very low upfront cost. I mean, it's not like you're starting a restaurant for $1 million or something. So things like that, like you said, Chris, if you're getting into real estate investing, a lot of education, coaching can help, and then it can bring in obviously home offices, stuff like that, if done properly. But Drew is saying, how does that work with a first lien HELOC?
Oh, he's probably referring to the cup game. Drew, in a first lien HELOC, I don't know. I don't know if they could they technically couldn't freeze that. I'm not really sure, Drew. I'll be honest. You stumped me on that one. I don't really have an answer. You probably, it'd be tough to do. Be tough to do in a first lien. Will said, talk to Joe K. That'd probably be what I'd say too.
Yeah, exactly. Can banks legally use BOLI to insure all employees or just their executives?
Just executives. They have to have an insurable interest. That's why you see so many vice presidents at banks.
Who should be used to deconstruct old LLCs and start new ones?
Corporate capital.
I have a whole life once myself already. I would like to do one for my parents that are of age. Does that affect getting them a policy? How long will they need to have the policy before the death benefit gets paid out?
Well, the death benefit will get paid out when they die, so hopefully not for a long time. There's only 2 contestability periods in life insurance. One of them is if you lie on the application and it gets issued, and then you die within 2 years, and they can prove that you lied to get the coverage. And the second would be suicide, if you commit suicide in the first 2 years. Other than that, just when they die.
James, what's up, James? So Reese and I were talking about cash value deployment last night, and decided that we are keeping 10% of cash value balance at the ready going into the new year, just in case. How about you, Stephen, Chris? What is your safety threshold? Or do you both just deploy 100% whenever opportunities present itself?
Good question, James. Mine's probably too high right now. I've got a lot of cash sitting on. I mean, if you count treasury bonds as cash, which a lot of people would because of the liquidity of them, then I'm sitting on way too much cash. And the reason for that is I've got money spread out in a lot of things. I'm pretty well diversified. I just did another 120 in another deal at a pretty low interest rate. Actually, it was just a smidgen over 5%, but I believe in the deal and I believe in the people doing it. It's very low risk. I'm paying off debts that I have for the businesses. So like real estate mortgages, as those mortgages are coming to maturity and the bank's trying to take me from 5 or 5.5 to 7 or 8%, I'm just buying them out with my policies. And then I'm having my rents or my company with my rentals pay me. So the simple answer, James, is way too much, is what I've got. Stephen, what about you?
I'm very conservative. I've said that now for about 2 years. I have trauma from 08 and I don't want to go through that again. So I probably keep more as well. And right now it's actually, I'm being even more select of where the money's going. So very, very conservative for myself.
Yeah, same. Not saying 10% is wrong for you, James. I mean, it's just for me right now, I'm keeping far, far more than that.
And to the tax question earlier, Jimmy he's a high level CPA and accountant. He said W-2 income can only be offset by active losses in other areas. Best way I find to do this is via depreciation. However, there are rules to make that house, car, asset active and not passive income. The 100-hour rule is a great active versus passive litmus test. Some advice there.
I would love when he's on here for the tax questions because I hate him. I don't have the answers. I call him or Zach or somebody else that's a CPA.
Oh, TV movie star too. He's good for the camera. We should put you on, Jimmy, one of these days.
I know.
All right. So Lionel said, off-topic question: did Prime Business Pros shut down? Their email no longer pulls up. I've never heard of them before. Lionel.
I've never heard of Prime Business Pros. So who do we recommend? I wish Jimmy took people, but Zach Newberry, if he's taking on new clients, if you're looking for a good CPA, he's really good. If you're looking for like bookkeeping services, corporate, we keep saying the same thing, Corporate Capital, Brent Carlson and his team are really good at bookkeeping. Yeah, any of those are good choices. Well, folks, now you know what it looked like right before the Great Depression. And also now you know what it looked like right before whatever this is going to be that's in the horizon. So I feel like you got a really good lesson for the first week of 2024. And from here, all we have is to build on that. We just got to continue to build with each of you, keep you all safe, just keep preservation of principle in mind. And with that being said, folks, thank you all for joining us for the first episode of Wealth Webinar in 2024. We'll see you later this afternoon at the Ask Me Anything. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.